Hi everyone, my name's Emma and I'm from mypropertyjourney.com, and today I've got my very good friend and accountant Neil with me to answer your property tax questions.
Thank you very much for having me. A little bit about myself. I'm CPA working for a firm in Melbourne. I'm currently studying my Masters of Tax through Melbourne University, and hopefully I can give some satisfactory answers to the questions that have been posted.
I'm sure you will. Okay, so the first question is as follows. I'm 29, live in Canberra and work in IT. I bought my first property 18 months ago and I live in it. It is 3 bedrooms and I rent out the 2 other rooms to very good friends of mine. We all play sport in the same team. My question is, as these 2 pay me cash, do I have to legally declare it for tax purposes? The ATO website is somewhat ambiguous around differences between rent and boarding and lodgement in this scenario. They've only been in since the start of the financial year, so trying to suss this out before tax time.
Well, it raises a number of issues, and it's a very sore spot for the tax office at the moment. Is the cash economy. At the end of the day, the technical answer is yes, you do need to declare it. The fact that you're getting cash doesn't really make a difference how you're getting paid from a tax perspective. It's more along the lines of, are you generating a regular source of income from this? You will definitely have to declare it in your tax return. Alongside of this comes a number of things. Obviously, the percentage of the house that you're renting out, so to speak, you certainly can claim expenses on. You do have to be careful about what you do and don't claim and how you calculate them. Generally, ATO's process about how they calculate the expenses would be to apportion it based on the floor space of the house. So the renters or the boarders have access to a certain amount of the house. That's a percentage of your expenditure you would claim. One would imagine that the person has a loan on the house, therefore they would also claim interest on the loan. The downside to doing this, and the downside to renting out your own home, is more, one of the biggest benefits the ATO grants us is the main residence exemption from a capital gains tax perspective. So the house that we live in, that is our primary residence when we own it, doesn't matter how much money we make when we come to sell it. If it's been our main residence for the whole time, you get that completely exempt of tax. In this instance, because a portion of the house is being used to generate income, that means that that portion of the house is excluded from the main residence exemption. So by declaring income and claiming expenses, you're stating that that portion of the house is not your main residence, it's an income producing asset, in which case when you come to sell it, you will pay tax on that portion of the asset. You would still get the main residence exemption on the portion that you live in, but you would lose that for the whole house overall. So it's certainly a situation where it becomes a more complex calculation when working out your tax. But yes, to the letter of the law, you do need to declare the income. That means you're entitled to claim the same percentage of the expenses, and you have to be aware of any tax obligations when you come to sell a property, if you come to sell a property.
Beautiful. Okay. Second question. I'm 34 years old. I live in Queensland with 5 investment properties and my own home. All my properties are in the outer suburbs and are 3 to 4 bedroom houses. This year is the first year I've been levied with land tax. According to the government information, you get charged 1% of your land value every year once you own over $600,000 worth of property, not including your own home. I find this pretty harsh and has slowed down my investing as I've reached this limit. Are there any ways to minimise the tax or get rid of it? I've heard some people saying you can set up a company structure to minimise it.
That final point is correct. I mean, at the end of the day, land tax is one of those things that is unavoidable, unfortunately. A couple of things come into this situation where I approached by a client with this particular situation. I would be, first of all, yes, you're certainly liable for land tax. That's fine. When looking at how to minimise land tax, it's going to be considered, but more what of a lesser consideration when looking at the overall situation. The idea of structuring your investments is one that's very prominent today, particularly as people start to grow their investment portfolio. Main one being levels of risk, and also dealing with levels of debt. So when someone says, I've got 5 properties, I'm looking to buy more, one of the considerations is how comfortable are you with having all of your investments in your own name? Someone hurts themselves in one of your properties, you're at risk of being sued. There are certain insurances you can take out to protect that, but at the end of the day, if you are sued on a personal level, all the assets in your name are at risk. This is where we would look at setting up another structure. From a residential property point of view, we tend to avoid companies because they're not eligible for the 50% discount when you come to sell those properties. That's just a flat rate across all companies. There is no discount, which is a major benefit in the capital gains system. So what we would generally do is look up setting a trust with a corporate trustee. That means that any gain when the property is sold is distributed out. One of the things you have to be careful with in trusts is where you've got a negatively geared property in your own name, you can claim that negative gearing against your other sources of income. In a trust, if a trust has a loss for the year, that loss is quarantined within the trust. Trusts cannot distribute losses, they can only distribute profits. So when looking at structuring, you have to take into consideration the levels of negative gearing on the property. It's preferable to have cash flow positive properties. The other advantage of a trust is you can, if you're a family, you have a partner and children, you can use them for distribution purposes. So if you've got cash flow positive properties, then you can distribute amounts of the income to other people to help even out your marginal tax rates. From purely a land tax point of view, all the SRO, the State Revenue Office websites across each of the states have details of their land tax rates. One of the things you will see is there is a threshold of $600,000 for individuals. There's also a separate threshold for companies and trusts of $350,000. So purely from a land tax perspective, once you reach that limit in your own name, if you are to then buy your next property in a trust, it gets its own allocation of tax-free threshold, so to speak. So you can invest in up to $350,000 in that trust before you start paying tax. So that, from a purely land tax perspective, yes, you can alleviate some of the cost by having a trust. The overall cost of land tax isn't a huge amount. The cost of setting up a trust would generally be between $600 and $1,000 for a good trust these days. So you have to weigh that up against the actual saving. At the end of the day, if you've got a lot of negative gearing and you're relying on that refund at the end of every year, you may avoid restructuring some of your investments because the negative gearing is just too good to lose. Again, it comes down to each individual person, so you would have to go and seek personal advice from an accountant such as myself to work out what will work best for you and how best. For someone running their own business, it's always preferable, it will generally outweigh the risks or the benefits of having negative gearing. You will generally look to have those properties owned externally to yourself because you are a high risk individual. Someone on a salary and wage is a low risk individual, lower risk of being sued, therefore having things structured in a particular way isn't as much of a concern for them. The negative gearing certainly will be. So it's something that's very particular to each individual, and it just comes down to how comfortable you are with your particular portfolio. Given that you've got 5 properties as well as your own home, I would probably start to look at having them in a trust or another structure, just as a matter of course.